Good morning.
Good morning, Satish ji. How are you?
I'm good. What about you?
I'm doing great. Good to
Good.
see you.
Yeah. Thank you. Thank you, Gaurav.
Very good morning to all of you, to all the friends who have joined us on a Zoom, and also to the friends who are joining on the YouTube. Uh, a very warm welcome to all of you in today's session. The objective of this session is to broadly discuss, about the taxation of non-resident, and within the taxation of non-resident, specifically the aspect claiming the double taxation avoidance agreement or claiming the benefit in double taxation avoidance agreement. We all know recently in July 2002, the CBDT has mandated the filing of Form 10F uh, for claiming the treaty benefit, and this has led to an issues and discussion among the taxpayers, not only in India, rather outside India, that when we need TRC, is it important to have TRC or is it important to file Form 10F online? What will happen whether we need to take permanent account number or we are not required to take permanent account number? If I do not have PAN, then would 206 AA apply, and the higher rate of taxation at 20% would be applicable? Or do I need to file income tax return in India if I'm taking a permanent account number? So all these issues, all these questions are there, in the minds of corporates in India, and also in the minds of non-residents. And we just got free from the pressure of 31st October, so I thought this is a good topic to discuss and share my view. Uh, I put a disclaimer: the view which I'm going to share, it's absolutely my view. It's not any published opinion or the opinion of some authority. So it is subject to challenges and litigation in the court. But what I'm going to speak is certainly what I believe upon. So let me first of all share the uh, problem area from where all the problem actually started. So this is the notification number 3, which was issued in July. And according to notification number 3, in exercise of the powers conferred under sub rule 1 and sub rule 2 of rule 131, and then they go on say that hereby specifies that the following forms, returns, statements, reports, orders by whatever name called shall be furnished electronically and shall be verified in the manner prescribed under sub rule 1 of rule 131. And then we have form 10F in point number 2, in serial number 2. So from July onwards, from this because of this notification, now filing form 10F electronically is a mandate. And if one needs to claim the treaty benefit as per section 90 subsection 5, then as per this notification, one needs to file form 10F. But till now, what I've seen that few organizations they are filing form 10F online. There are taxpayers who are still taking 10F in a hard copy. So there is slight confusion. So let me, before I move on to section 90, which is a very important section, let me briefly touch upon how the system works. So we have section 5, we have section 9, which talks about or which defines the scope of income for non-resident when that not income earned by a non-resident is taxable in India. So section 5 broadly says that if the income is received in India, section 5 subsection 2, that whether if the income is received in India or deemed to be received in India, if it is accrued in India, or if it is deemed to be accrued or rise in India, then the income is taxable in India. So which means if you are not falling under subsection 5, if you are not falling under section 5 subsection 2, then income is not taxable in India. So we may have a transactions with non-residents wherein the income per se is not taxable in India, or the transaction per se is not taxable in India. There could be another scenario wherein, let's say, transaction is taxable in India. When you read section 5 subsection 2 along with section 9, the transaction becomes taxable under the Income Tax Act. And then we go to section 90, which allows the assessee to use more beneficial provisions which are there in DTA vis-a-vis Income Tax Act. And let's say if you go to double taxation avoidance agreement with that particular country, and the income is also taxable in DTA. So if income is also taxable in DTA, probably the benefit that DTA may give you, and which is not in case of every double taxation avoidance agreement. But yes, in some cases, we might see that the tax rate is lower in DTA in comparison to the tax rate which is given in double taxation avoidance agreement. There could be third scenario wherein, let's say, the income is taxable under the Act, but the income is not taxable under the double taxation avoidance agreement altogether. So broadly, we have three scenarios. The first, wherein the income is not chargeable to tax or which is not taxable under the Income Tax Act. Second, the income is chargeable to tax or income is taxable both under Income Tax Act and double taxation avoidance agreement. But you have, beneficial rates available in double taxation avoidance agreement. We can divide this, when the income is chargeable to tax both under Income Tax Act and both under DTA in two categories. Let's say the category A, wherein the tax rate are more beneficial in the DTA. Second category is wherein the tax rate in the DTA are higher or equal to Income Tax Act. So means they are not beneficial. Third scenario is wherein transaction is taxable under the Act, but it is not taxable under the DTA. So particularly, with regard to point number 2A and point number 3, one may need to go for a DTA. So point number 2A would be that the income is taxable both under the Income Tax Act and under the DTA, but the tax rate in DTAs are more beneficial than under the Act. So you will opt for DTA, or you would like to opt for double taxation avoidance agreement. Third scenario is, wherein the income is not chargeable to tax under the DTA. So you would like to opt for DTA in order to avoid taxation in India. But let's say if you are falling under point number 1, that income is altogether not chargeable to tax in India, then you will not go to DTA. And if you're not going to DTA, probably the issues like 10F, TRC, does not of much importance, or they will not get triggered. For example, let's say you have a commissioner agent outside India and you are paying commission to someone in New Zealand or someone in London for the sales made abroad, and he does not have any business connection in India. So when you're making a payment to such a non-resident for, of commission, then the income is altogether not chargeable to tax under the Act. And if it is not chargeable to tax under the Act, you're not required to go to the double taxation avoidance agreement for any benefit. And you can simply restrict yourself within the premises of the Act. There could be similarly other scenarios, wherein you are making remittance to the non-resident and the income is not taxable in the Act. So it becomes very important, before we start looking for tax residency certificate or Form 10F. I think the very first point which all of us, needs to evaluate whether the income is subject to tax or whether the income is taxable under the Income Tax Act or not. And if the income is taxable under the Income Tax Act, then only we will see whether we need to take the benefit of double taxation avoidance agreement or not. So if your income is not taxable, I think one should not be too much worried about whether the non-resident is giving you tax residency certificate or not, or whether the non-resident is giving you Form 10F or not. So that goes for a toss practically. But yes, recently we have got significant economic presence provision under Section 9 via explanation 2A. So generally, we understand that most of the goods transaction wherein we are importing the goods or online service transactions are not taxable because they do not have any business connections, and we do not have any specific provision under Section 195 to charge those incomes or those transactions on gross basis. But because of the significant economic presence, one may need to evaluate that even though the non-resident does not have any physical presence or does not have any agent in India, but does he have some kind of electronic or digital presence because of which he is able to make sales in India? And if yes, then probably the provisions of significant economic presence may get triggered. Now, SEP is such a scenario wherein we have significant economic presence rules under the Act, under the Income Tax Act, but we do not have significant economic presence rules currently under the double taxation avoidance agreements or even under the MLI signed between various countries. So wherein the non-resident is getting, under the coverage of SEP, at that time, taking treaty benefit becomes important, and probably one needs to have TRC and 10F. But I will come back to point number one, that it is important to evaluate whether the transaction is taxable under the Act or not. And if it is not taxable under the Act, then we are not required to be worried about 10F or TRC. We can simply go ahead and if you need to issue 15 CB, you can very well issue the 15 CB. If you want to make payment to the non-resident, you can very well make the payment to the non-resident without having the TRC or 10F or NPAN or whatever. But yes, certainly, before we say that income is not taxable, I think certain clearances are must, that the entity does not have permanent establishment in India, or the entity does not have any business connection in India. And I trust, you will going to take all those certificates. You will going to ensure that the client or the taxpayer is not falling within the premises of business connection or permanent establishment in India. Now, there could be a second scenario wherein the transaction is taxable both under the Income Tax Act and under the double taxation avoidance agreement. And if the transaction is taxable both under the Income Tax Act and under the double taxation avoidance agreement, and the rates are more beneficial in double taxation avoidance agreement, then only people start looking for giving the treaty benefit, and there comes Section 90 in picture. Also, we may see a scenario wherein the transaction is taxable under the Act, but transaction is altogether not taxable under the DTAA. For example, we have fee for technical service clause in Act, and the definition is pretty wide. But if you are dealing with some US bound company, US resident or a UK resident, their treaty provides make available clause, and make available clause generally narrows the definition or narrows the scope of fee for technical services, which means the transaction is taxable under the Act, but because of this make available clause under the treaty, the transaction may not be taxable under the double taxation avoidance agreement. There could be another scenario. Let's say you have a most favored nation clause in the DTA, and because of the most favored nation clause, there is a change in the scope of the DTA, and the income is moving out from the taxation. So when we are moving on to this third scenario, that is income is taxable under the Act, but it is not taxable under the DTA, and the taxpayer wants to opt for the DTA, then section 90 will again get triggered. So in two scenarios wherein we want to opt for a reduced rate of taxation, or we want to opt for nil rate of taxation because the income is not taxable under the DTA. Then we have TDS provisions also in place, wherein the payer is required to withhold the tax while making a payment to non-resident, and we have section 195 and other sections relating to non-residents. But interestingly, we have also another section 206 AA, which says if PAN is not available, then the higher of the rate would be available, applicable, the rate in the Act, the rate in force, or 20%, whichever is higher. And there comes the problem that if the income is not taxable, I need not worry about 206A, I need not worry about DT, I can simply remit the money. But if income is taxable, what to do? Now I need to take 10F, and if 10F is not there because of the PAN, do I need to deduct higher rate of TDS 20% because I do not have PAN? The taxpayer is not submitting the TRC. So what to do? So in next 10 to 15 minutes with this small background, let me try to clarify the taxation scheme. So let me take you to the notes which I prepared notes. These are not technically notes, but I did cut copy paste of relevant provisions of the Act. So let's read section 90. Section 90 says an assessee, I'm straight away on subsection 4. An assessee not being a resident to whom an agreement referred to in subsection 1 applies shall not be entitled to claim any relief under such agreement unless a certificate of his being a resident in any country outside India or specified territory outside India, as the case may be, is obtained by him from the government of that country or specified territory. The assessee referred to in subsection 4 shall also provide such other documents and information as may be prescribed. So section 4 and subsection 4 and subsection 5 under section 90 are technically independent. And if you read section 90, it says one needs to provide the information inquired in subsection 4, which is tax residency certificate, plus the information which may be called for in subsection 5. So these are two separate subsections, and within the law, it is not like if you are providing information in subsection 4, then you are not required to provide information in subsection 5. It's simply, the government may ask you the additional information in subsection 5 in addition to subsection 4. And if you fulfill both subsection 4 and subsection 5, that is TRC plus other information, then only one can claim the treaty benefit. This is within the law. Now, if I move on to the relevant provisions, relevant rule with regard to section 90, it's rule 21AB, which says subject to the provision of sub rule 2 for the purpose of subsection 5 of section 90. Now here it is not talking about subsection 4. It is simply talking about subsection 5. It says subject to the provision of sub rule 2 for the purpose of subsection 5 of section 90 and subsection 5 of section 90A, the following information shall be provided by an assessee in form 10F. And the information is status, nationality, assessee's tax, identification number in the country specified, territory of residence, in case there is no such number, period for which residential status is mentioned, address of the assessee. So all this information one needs to submit in form 10F, and interestingly, you will not find permanent account number written in sub rule 1. It's only, there are few 4-5 information which are given. And then you have point number 2, which says the assessee may not be required to provide the information or any part thereof referred to in sub rule 1 if the information of the part thereof, as the case may be, is contained in the certificate referred to in subsection 4 of section 90. So which means, if you have got a tax residency certificate which contains all these informations, then you do not need form 10F. So 10F is not mandatory in every case. It is only mandatory when your tax residency certificate does not have status, does not have nationality, does not have a tax identification number, does not have period, does not have address. Believe me, you will find generally in most of the cases, all this information should be there in the tax residency certificate. For example, it will talk about XYZ is a company who is a tax resident of US, for example, wherein the tax identification number is this, and it is applicable for this period, and this is the address of the organization. So I've seen few TRCs, wherein one can find these information. So when you're going for evaluation of 10F, my first advice is go through the tax residency certificate very clearly, and not in every case you need 10F. So when TRC contains all this information, you are practically out of form 10F and you do not need form 10F. But if you do not have, if any of the information is not there in the tax residency certificate, then certainly form 10F becomes mandatory. And now, because of the notification number 3, the filing of 10F is mandatorily, we need to file it electronically. There is no other way out that you can do it in a hard copy. So the non-resident company needs to file it online, and filing it online means that non-resident company should have the permanent account number, and also the one who is verifying the form, he has got a valid digital signature to verify the form 10F. But it is only applicable if you wish to take treaty benefit. And if you do not wish to take treaty benefit, then you do not need form 10F or tax residency certificate. Now we have a close provision with this 206 AA, because the question may come that if we are not opting for treaty, then do we need to give higher rate of tax under section 206 AA because we do not have PAN? Because to avoid PAN, we are moving to 206 AA, and 206 AA talks about PAN. So does it mean that if I will avoid tax residency, if I will avoid form 10F, do I need to pay higher rate of tax under the 206 AA? Let's see what 206 AA say on this. So here is 206 AA. It says requirement to furnish permanent account number. Notwithstanding anything contained in any other provision of this act, any person entitled to receive any sum or income or amount on which tax is deductible under chapter 17B shall furnish his permanent account number to account to the person responsible for deducting such tax. However, the provision of this section shall not apply to non-resident, not being a company, or to a foreign company in respect of payment of interest on long-term bonds as referred to in 194 LC, and any other payment subject to such conditions as may be prescribed. So now what are the conditions? It is given under 37 BC, and 37 BC, if you read, it talks about that in the case of non-resident, and if these type of transactions are there, interest, royalty, FTS, dividend payments on transfer of capital asset, the assessee must give these kind of documents in para 2 to the deductee. and the information or details which needs to be given to the deductee or which needs to be collected by the the one who is making the payment, the deductor, is name, email ID, contact number, address in the country or specified territory outside India, a certificate of his being resident in any country, that is TRC, tax identification number. But interestingly, it does not talk about Form 10F. So now, I have got two options. One, if I want to opt for the treaty benefit, I should have both TRC and Form 10F, and 10F needs to be filed online. But if I do not want to take a treaty benefit, I'm happy paying taxes in India, then you may pay tax plus surcharge in India, even if you do not have permanent account number, with the TRC plus the information required in 37 BC. And you will simply get away from having a permanent account number in India. So the first confusion, if you do not have PAN, and if you do not have PAN, you have tax residency certificate, do 206AA trigger? To best of my knowledge, it will not trigger if the recipient provides certain basic information which are given in 37 BC. So in most of the cases wherein you have tax residency certificate of non-resident, 206AA shall not apply. That is, higher rate of taxation will not apply. So what will apply? It will going to be the rate mentioned in 206AA, which is 10%. Which is rate as per chapter 17B plus surcharge. And if you go to further, 115A, let me take you to 115A. So it's a tax on dividend, royalty, technical services, fees in the case of foreign company. So it allows not to file return in India, or it gives exemption or benefit to non-residents for not filing return in India. And the rate under 115A is again 10%. So if the non-resident is ready for rate of TDS, which is 10% plus surcharge, then the non-resident, to best of my mind, do not need permanent account number, but he should furnish tax residency certificate. So if you have got the TRC of the non-resident and certain basic information which are under 37 BC, you may simply deduct 10% plus surcharge and make a payment to non-resident, and he is not required to file any return in India. He is not required to take permanent account number. So, but this exemption of not filing return in India is in case of dividend, royalty, technical services, and also we have 115BG, 115G, which talks about capital gain. So in these cases, you are not required to file any return in India. But let's say if you wish to take treaty benefit, in such a case, the tax rate will come down to 10%, or wherein, the transaction is not taxable altogether in the treaty. Therein, I think it is useful to go for a treaty benefit. And in such a case, the non-resident must provide you the tax residency certificate along with Form 10F. And Form 10F now can only be filed if the non-resident has got permanent account number. So this is for sure when you want to give treaty benefit to the non-resident. I think I'm done with my piece of information. Now we can go for open house. If you have any query on these aspects which we have discussed, feel free to unmute you. And
Gaurav, as I asked you the query last night, 2 days earlier, this is in case of Toastmaster International, as I informed you, is in USA.
Satishji, my request is not to take a name of any client.
Okay.
We would be able to discuss it now after the call. because sharing information about the client does not look nice on a public
Okay.
platform.
Like, so as you now informed that if TRC is available, having all those 5 informations as per the section rule 21 AB, then we can go for 10.4% deduction.
Yeah, what I was saying that if the client is ready for 10% plus surcharge under the act, then what you need is tax residency certificate and the information which is given in 37 BC, which is email ID, TRC, the address, all that stuff. So you can take that information on the letterhead of the client, letterhead of the non-resident, and give it to the resident in India. And resident can issue, can deduct 10% plus surcharge and make a remit a payment to the US.
Okay. Thank you, Gaurav.
Gauravji,
Hanji.
Gauravji, this is Anthony. My question is regarding in the next step. When the deductor received 37 BC declaration and TRC, how to present all these documents and information in TDS returns? Because I could not find the proper place to disclose all those information in our TDS return.
But you are not required to disclose all this information in the TDS return.
There is a tab wherein the 15 CB number is asking the document generated by acknowledgement ARN number they are asking. After that they are not asking, and the system is taking still 20%.
My limitations is, generally the TDS return is filed by my team in office, and
Okay.
I practically for a long have not seen, the forms, and until they have some technical issue, they do not come to me.
Yeah.
So
Okay. Then we can discuss it privately, separately.
Yeah.
गौरव जी मैं कुछ इसमें ऐड कर दूं?
हाँ जी, please.
कैसे हैं गौरव जी, कैसे हैं?
All well, Atul ji.
ऐसा है, there are the drop downs हैं, there are in the form 15 CAFCB, there are drop downs, and once you go to the drop down, if you say it is taxable in India, then it asks you for the other information. If it is not taxable in India, then it asks for the reason. That's it. Otherwise, it is not so complicated that filling a form 15 CV will have a complicated documentation there.
No, sir. My question is not that. 15 CACB is okay. We have generated that. My question is about to file TDS returns.
Anthony ji, my suggestion is let's stick to the topic. I will after this session maybe tomorrow.
Sure, Gaurav ji. Thank you.
Okay, so let's have
one query. Like, at what point of time the form 10F is to be filed? At the time of approval or payment to the non-resident, or at the time of filing of ITR by the non-resident?
Okay, this is a very good question. So in my view, there are various incidents of tax, various points on the timeline. So when you are deducting a TDS, when you are making a remittance, at that time you should have 10F, you should have TRC, and then only you can give benefit of treaty to the non-resident. So at that time of, let's say if I'm making a payment today, the liability of TDS arises when you are actually booking a transaction. So if I'm booking a transaction today, I may be making a payment after 6 months, but the TDS liability is at the time of booking a transaction. So TDS liability is today. And if today I have TRC and 10F, then I can very well give the benefit of treaty. If today I do not have the TRC and 10F, I will not give the benefit of treaty. I will deduct the tax within the act. Now, if later on the non-resident has got TRC and 10F both, in such a case, the non-resident can file a return in India, which he must do, and then he can claim refund from the tax authorities. But as a deductor, your liability of deducting a tax is at the point of booking a transaction.
Got it. Thank you.
So Gaurav, as he also rightly asked, if the non-resident is not having PAN number, then TDS return, despite having deducted TDS, we cannot file the TDS return. And if we are not able to file TDS return, we cannot give the non-resident the certificate of this TDS.
I think it is possible to give. How, there are various other documents through which even if the non-resident does not have PAN, you communicate to them that you have deducted a TDS and they are claiming a valid credit in their own country. So this can happen. I think there is no issue in this.
Okay. So while filing TDS return, there was option PAN, not AVBL. Then
वो कुछ होता है
sir, yes.
वो actually मैं TDS return नहीं file करता तो मेरा I don't know how
I know, but practical issue comes that despite deducting TDS, you're not able to generate a certificate and give it to non-resident.
But certificate, see, there are various documents. For example, under the Indian income tax also, if the non-resident has deducted the TDS, there are various documents which you can submit to the tax authority, and not only the one document. So same rules are there in other part of the world also, that the non-resident needs to prove that yes, the valid TDS has been deducted, and they may do it through a management certificate. They may do it through a account statement. So there are other ways to prove that tax has been deducted in India.
Okay.
Just to add one thing. So we can download the transaction-based report from traces, which evident that TDS has been deducted in case of non-resident not having PAN in India.
Sir, can you repeat? Can you repeat, please?
There is a transaction-based statement which is being downloaded from traces once you file the TDS return for a non-resident which does not have a PAN in India, and it is a sufficient proof to evident that TDS has been deducted in India.
Yeah, so this is what I'm saying, it is very much possible. The only thing is I do not do in my team, so I'm not having very handy stuff on the traces or on the returns. But yes, there is no challenge with I've never seen any non-resident having challenge in taking credit if they do not have PAN in India. So we can move on to
Gaurav ji, मेरा छोटा सा question है. There are few of my clients are expatriates. और उनके केस में उनको हमने एक नेट फिगर, किसी को $1 लाख, किसी को $1.5 लाख देना होता है. तो चैलेंज तब आता है when we rounding it off and saying that it is net of taxes. So when we make the calculation, sometimes the amount exceeds 1 crore rupees, then surcharge has to be charged. How to make that adjustment in the calculation?
Sir, Atul ji, the discussion will go on a different tangent. I want to stick to 10F today.
Okay. ठीक.
So Manish ji has got a question. You said Form 10F not compulsory if TRC has all the required info, or do we need it? Sir, Manish ji, there are two sections, two ambit on which you need to work upon. If your client is happy with 10% plus surcharge in India, then it is TRC plus certain information which are required under Rule 37BC, and 37BC does not have any prescribed format. So if you are going with 10% plus surcharge, then it is simply TRC and certain basic information on the letterhead of a non-resident will work. But if you wish to take tax residence, if you wish to take double taxation avoidance agreement benefit, then it is 10F plus TRC. And then we have Rule 21AB, which says if TRC has got all the information, then you do not need 10F. So if your TRC has got the information which are required, then you do not need any 10F form, and the information which should be there in the TRC are status of the SSC, nationality, tax identification number, period for which residential status is mentioned, address of the SSC in that country. If your TRC contains all this information, then you are not required to submit 10F. Very clearly, this is given in sub rule 2 of Rule 21AB.
Thanks, Gaurav.
Okay. Any other question on the on 10F or TRC issue.
Can this 10F be filed by a non-resident who doesn't have a PAN?
No, it cannot.
So then in that case, what happens?
If the non-resident is not filing 10F and the TRC does not contain the relevant information, in such a case, the non-resident will not get treaty benefit.
Okay.
One point, Gaurav, even in case where PAN number is available, so generally clients deduct at 10.4 flat, even if the TRC is not there. Is it correct or not correct?
So if PAN is available and you wish to deduct flat 10.4, I think it's a valid point. You can do it.
Yeah, that's thanks.
So, sir, this means that Act is overriding DTA in this case, because PAN is being made mandatory for a non-resident to obtain treaty benefit, which should not be the intention of the tax treaties.
No, Sahil, it is not like that. It is, let's put it in this way. In general, all of us are allowed to drive a car in India. We can all drive a car, but we need to have valid documents. I may be having a license, but if I'm not carrying a license while driving, the traffic police guy can always stop me. So 10F is a document. They are not denying your right, but the point is you should have valid documents. For example, you can travel to US, you can travel to Canada, nobody will stop you. But if you do not have a valid document, everyone will stop you. So it is not through 10F, they are not hampering your rights. But yes, being a independent country, we have all right to tell you that what documents you must carry while moving in India.
So Gaurav, one point, 10F is there for many years, right? So now the change is that it has to be now online filing. That's all, or something else?
That's it. So earlier 10F used to, the non-resident used to give 10F to the resident. It was not submitted to the tax authorities until unless tax authorities specifically demanded Form 10F. But now essentially it needs to be filed online, and it would be routed through the portal of the CBDT. So from the day one, now the 10F would be shared with the tax authorities.
Right. Thank you.
Okay, I trust, we are clear, all of us are clear on the requirement of 10F, and when we do not need 10F, when we can simply go without 10F. So my request is apply the discussion that we have done, go through the rules, apply all these rules and discussion on a transaction by transaction basis, and just simply do not go by what is going in the market that we need 10F in all the cases. With these words, thank you all of you. See you soon.
Thank you,
Thank you,
Gaurav.
Gaurav.
Thank you so